What is up, guys? Welcome back to another episode from Coin and Capital. It's Chris here. And on this channel, we break down headlines, data, charts, whatever it may be that has to do with economics and our future. We talk about it, try and find some truth, and bring that truth to you guys. And today, my country, Canada, is in the hot seat. I figured it's been a couple weeks. We haven't heard much from Canada. Go figure. Nobody has. It's time to check back in, make sure the narratives proposed on this channel still hold, make sure those who live in Canada, like me, know what's going on and what they can do to circumvent this one-way train our government has put us on. Talk about the bond market, take a look at the TSX, touch base on some trade talks with Canada and the rest of the globe, and then finally, where does this all end for Canada, for the banks, for our guy Mark Carney, and for people like you and me? Let's get into it. Into the bond market, specifically the long end of the market. Okay, talking 30-year and 10-year. Now, the thing is, with Canada, nobody wants to hold duration from Canada and pretty much any fiat country in the West right now, which is all of them, right? Nobody wants a 30-year, a 10-year commitment promised to be paid back in fiat that will lose 30, 40, 50% of its value over that time. So nobody wants that. And so that risk, right, gets priced into the bond markets, which is why on the long end in Canada, yields have been slowly trying to grind their way up. However, in Canada, we have this weird policy mechanical yield curve control, not really yield curve control going on, right? Where basically capital control in the bond market, where policy has forced these big banks in Canada, the best business model in Canada, to own and soak up duration issuance. Well, the rest of the world sees risk in Canada and no longer invests because they have the choice, because they're not bound by policy or capital control. They avoid our bond market and sovereign debt market entirely, right? Whereas the banks and everybody inside Canada is being forced to hold this useless duration that loses real value over time, right? And because of this mechanical function that's in place, bond yields are essentially capped, right? Because at any given time, the big five banks can relever to absorb this duration issuance. Part of what we're seeing today in the bond market with the yields trying to climb in duration is from this risk constantly being priced in. And when the banks aren't there to take that side of issuance, yields will rise. And in conjunction with that, when we're looking at the TSX, right? So the TSX and the S&P 500, the NASDAQ 100, all of these indices are going to give you a super accurate proxy as to what the liquidity backdrop is like in that given country, right? So we know US M2 has like a very strong correlation to the S&P 500. Same thing with Canadian M2, very strong correlation with the TSX. When the TSX is chopping like this and trading down, we can infer to a high probability that the liquidity backdrop in the market is contracting. And when that happens, markets tend to dysfunction, right? Especially in this day and age when governments are laden with deficits, ever-growing deficits, needing to constantly refinance old debts and roll over newer existing debts, liquidity has to be ample to take the other side of that, right? And especially in Canada, liquidity has to be ample in order to continue this mechanical yield curve control that's in place, right? So when liquidity is contracting, that makes it extremely hard. In Canada's case, it makes it extremely hard for the big five banks to soak up duration issuance, right? And when it's hard to soak up that issuance, well, really nobody else is there taking the other side of that unless you're 70 or 80 years old and still buy bonds because you still believe in risk-free rates. I don't know anyone my age taking the other side of a 30-year Canadian government issuance. It's just not happening, right? So when the banks aren't there, nobody really is there to take it, and then yields rise. Moving on. Prime Minister Carney, our boy. Just kidding. He's not our boy. We did not vote for him. We don't believe in the political system here. We vote orange. We take back control and exit the system peacefully. Anyway, Mark Carney, he's been busy making deals, diversifying Canada's reliance on the U.S., slowly pulling away from the madman Trump, tariff this, tariff that. Oh my God, he's so bad. Canada wants nothing to do with it anymore. So Carney has been hard at work, making deals, EU, Sweden, all kinds of stuff, which sounds great and all, right? However, Canada has an extreme productivity issue. Okay. When the best business model in a country is a bank financing mortgages and absorbing 30-year issuance, you know you have a problem, right? When a country that is rich in natural exports, when the top business models are not revolving around anything to do with that without boosting productivity, right? When a country becomes hyper financialized to support fiscal dominant regimes, productivity begins to suffer. Who would have thought? Who would have thought, guys? When you're making money off a mom 60-year mortgage because she can't afford a bloody house, like, make it make sense, please. On top of that, population crisis imminent, right? The biggest bubble in the workforce is aging out, which is my parents' generation. They're looking to retire soon. A lot of their friends are looking to retire. That entire generation moving out of the workforce, right? No longer producing, being productive, making money for the Canadian government. That's a big problem too. So we subsidize that with immigration. That's its own problem because then we have AI. Whole other conversation, right? Thing is, Canada making all these deals, what's really in it, right? What are we going to export to them? I don't know. And the one thing I do know is that all of these deals are going to take time. And the longer the time spent in Congress trying to pass these bills before things actually start to take effect, this mechanical yield curve control, this financial repression and fiscal dominance will continue. And the longer that continues, the worse it gets, right? Like, it's a compounding effect. And so, because the Bank of Canada and the Government of Canada have established this mechanical yield curve control to cap rates to effectively make their deficit financing easier so they can issue more debt, such and such, they have pretty much total control over the bond market, right? So the release valve for all of this noise, fiat, debasement problem can no longer surface in the bond market, right? And it can't surface in the housing market, and it can't surface in outright consumer inflation, right? Because we saw what happened in COVID. There was uproars, very unsettling. So the only release valve Canada has left is the currency. Now, this is a very interesting correlation I found. Here we have the energy ETF index from Canada. And then in the red line, we have the Forex pair, Canadian US dollar. Very interesting, because when energy prices take a hit, so does our currency. And now what is going to happen in this world of AI, robotics, when energy becomes cheap, damn near free? What is going to happen then, right? We have to begin asking ourselves these questions, because it is going to become a reality 5 to 10 years out. This also highlights a very strong weak point in Canada, because we rely so much on energy, on oil. So what happens when those prices fall? Well, our currency gets weaker, because that pricing, that risk premium can't be expressed in the bond market. People short the currency, people flock out of the currency, and it depreciates. Finally, last thing I want to show you, to confirm this mechanical yield curve control situation going on, we have a BMO bond ETF. This ETF holds 10 and 30 years, and it moves in lockstep with the 10-year. If that doesn't scream mechanical yield curve control, I'm not too sure what will. BMO, one of the biggest banks in Canada, its ETF mimics 10-year yields. So when the banks buy, yields depreciate. When the banks aren't buying, yields explode. So, what can people like you and me in Canada do to circumvent all of this noise, all of this fiat propagation and inflation and debasement, all this fiat stealing your time and energy, and all of these risk premiums floating around with our country? We can buy Bitcoin, we can buy gold, we can choose to exit the system peacefully, take our money, put it elsewhere. Don't listen to your bankers. Don't buy any more duration, right? This duration is not going to help you no matter what they say. Trade your currency that carries very high risk in today's environment for something that has proof of work, preferably a finite supply, and won't steal your time and energy. Guys, it's very simple. If me, a 23-year-old college dropout, can figure it out, I'm sure you can, and hopefully these videos help with that. So if you guys enjoyed, drop a comment down below, hit that like button, make sure you subscribe. Catch you guys in the next one.